Today, we will be discussing about listed real estate securities within a real estate investment portfolio. Now, to recap the previous session, we presented a diversified real estate portfolio, which comprises cash, real estate securities, funds, and direct investments with different degrees of liquidity. Today we will be talking about this second block, the real estate investment trust and real estate development companies. Now, there are two ways of investing in real estate. One is to fundamentally own real estate and earn rent, and this is typically done by owning real estate investment trust and developing the real estate, and this is done by development companies. Now, clearly the lines are not clear cut, and it is perfectly possible for a REIT to develop an asset, like it is possible for development companies to retain assets for a rental book, but typically the percentage of income versus development gains determine the two. So why they are different? The real estate investment trusts have typically predictable income because they own fully completed assets which generate an income, and the income is easily measurable. They have, as a result, a lower risk, which obviously results in a lower return, and they are tax efficient. In many countries, the governments encourage owning real estate for the long term, so they don't put any tax on these REITs, provided that typically 95% of the income they generate, net income, is distributed by way of dividend. And there are two types of REITs. There are REITs that are internally managed, so they have their own investment team as employees, or externally managed. In this case, they are not different from an investment fund with an external investment manager. And this has implications on how much a REIT is attractive to the investor base. For example, in the US, it's very common for REITs to be internally managed. The market doesn't really like externally managed REITs. In the UK, is the opposite. The market is quite comfortable with externally managed REITs. But usually when the REITs become of a certain size, $2, $3, $4, $5 billion, it becomes more cost efficient to have an internal management team as opposed to pay a fixed fee to an external manager, which keeps growing irrespective of the assets of the REIT. The development companies clearly have development strategies, so they will acquire a land bank over multiple cycles. So they will arrange for building permits, build, and typically sell. So therefore, this is a much higher risk type of activity, and they are taxed as normal companies. And invariably, these are internally managed companies. Now, we also talked about the risk and return of various strategies. We have core real estate investment strategies, core plus, where there is a little bit more vacancies. We have value add strategies where there is a refurbishment activities, and there are opportunistic strategies where there are developments. So the REITs typically operate in the first three segments of the strategy, so on the lower risk. And real estate development companies operate in the opportunistic. So when we build a portfolio, we might want to have a combination of both development companies and REITs. And usually we will have more REITs to keep the overall risk of the portfolio lower, and some exposure to development companies. So now let's put first of all, the real estate sector within the wider context to understand, to draw some important conclusion. When we look at a market index like the S&P 500, we can see that the real estate sector is a very small component of the index. It's 2.75%. And this is true also of the global indices, like measured by the MSCI World Index. So the real estate sector, it doesn't make a big difference to the overall portfolio of an investor. And we can actually see this better when we look at the performance of the real estate sector relative to the broad market. Okay. As you can see, this is going back to 2005. The real estate sector was primarily generating returns in line with markets for 10 years until 2016, and then actually underperformed the wider market. So one might wonder why would you spend so much time in looking at the real estate sector when the market has delivered, the wider market, which includes the real estate sector, has delivered, especially in the last few years, a better return? Well, the answer might come looking at the next chart, where I have overlaid the new, the FTSE Nareit New Economy Index, which is this purple line that actually outperformed the broader market. So what is the answer to my question? We will look at real estate as a standalone sector when only limited to the REITs that can outperform the market. So why did I take the new economy? Okay, it's because over the last few years, the outperformance of the broader market has derived from the technology sectors. So the REITs that own the assets used by technology companies, i.e. the data centers, the telecommunication, and also the industrial assets, like logistic assets that are used for e-commerce, have actually tracked and even outperformed the broader market. So when we are building a real estate portfolio and we are using REITs, what we want to do is to focus on those REITs that have the potential to track and even outperform the broader market. So here is the final slide for today's session. So we look at the comparison within the real estate index. See, real estate is a very interesting sector. It is a sector within the wider sector, but because it offers physical assets, buildings used by other sectors, it can actually be reclassified in its own to the wider sector of the economy. So let's look at 2010 and how things have changed at the end of 2020. Things have not changed much in 2021. So this snapshot on the 31st of December 2020 is actually quite relevant. So 10 years ago or 11 years ago, the largest exposure of the within the real estate sector was to the retail sector. Shopping centers, that were the flavor of the month. Then we had the residential sector, the healthcare, offices, diversified. The self-storage, the industrial sectors were very, very small components. Fast forward 10 years after, and you can see how things have really changed. The infrastructure sectors today is 17%. And we are talking here about the digital infrastructure, so data centers, telecom towers, okay? We have the industrial sector on the back of the growth of the e-commerce is much greater, okay? The lodging sector, the residential sectors, they are all much larger. So the office sector is smaller and the retail sector has shrunk to 11%. So when we look at the new economy versus the old economy, we can see that reflected in the real estate sector. Sorry, in the composition of the real estate sector. So in conclusion, when we build a diversified real estate portfolio and we start investing, building the real estate component, listed real estate component, what we want to do is to focus on the new economy, on the properties which are used by the companies that are leading the digital transformation, the energy transition, and the sustainable urbanization trends, which will stay with us for the next decades.